Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for joining us, giving us a few minutes of your time, where we're going to talk about a few of the things that we feel are worthy of your attention. And this week, we're going to take a look at the Federal Reserve and their move last week to increase interest rates, and more importantly, what the outlook might be going forward. We're going to break down the stock market versus the economy, a topic that we revisit periodically because it's important, as it's easy to keep those two or to get those two tied together. And it's important to have a different lens with which we look at them. And Andrew's going to cover that for you, as well as stock market seasonality. So let's jump right into last week and the Fed's move to increase interest rates. So this is just one more along their path. It's really been a historic pace of raising interest rates. They're well up above 5% now after taking a pause last month. They resumed and gave us a quarter of a point. Going forward, the Fed left little clues in terms of whether they will be done or not. They want the door to be open to do either of those. And that's a really understandable place, a really understandable outlook, because between now and then, we're going to get two key inflation data releases, as well as some more information on jobs, and they'll have a fuller picture on where they want to go. So we've had inflation begin to cool. So it's quite possible that they are beginning to win the war against inflation, but they don't want to make too much about a temporary or what could be a temporary slowdown in inflation. So we'll get a little bit more data, and then they'll make a decision. I really do think it's a live meeting in terms of which way they could go. During the question and answer session, one thing that stood out that I think is important, and it's important because while the Fed was balancing their dual mandate of full employment and tame inflation, in managing that, they have this friction or this outlook and how they have to weigh those two. And there's a thought by some that they may believe that they have to cause a spike in the unemployment rate to really break the back of inflation. But he had this line in here. I won't read you the whole paragraph, but basically he said he doesn't see a recession as a necessary or to see a meaningful increase in the unemployment rate as a necessity in defeating inflation. So that's a really key clue into their thinking, and it could be good news. It is more evidence that they very well could be done, assuming that we don't see an uptick again here in inflation due to oil prices resuming or whatever it may be. So all eyes on that one. The last thing that I will tell you regarding interest rates is that the Fed controls very short-term rates. They could very well pause, and long-term rates could sail on. Then, in fact, that happens periodically through history when the Fed can actually just not be doing anything, but long-term rates have a mind of their own and sailing higher. But in terms of the short-term rates, we very well at least could be done for the time being. So that's a little lot of economic stuff, and we're going to pivot that. And Andrew, you're going to tell us how to think differently when it comes to weighing economy and stock market.
Yeah, thank you, Adam. We're going to do a soft transition. We're still going to be talking a little bit about the economy, but starting to work us a little bit closer to the markets. So a question we often get asked is, we see in the headlines, we see the news stories about maybe an impending recession. Are we going into a recession? Is the economy going to crash? Are we going to see a repeat of 2009? On and on and on. A lot of these scary type headlines. And we often try to remind the families that we work with, we try to remind you almost weekly in this market carver, is how focused we are on the stock market. We're focused on the bond market, the markets that we are buying and selling in every day, every week, every month. Remember, we trade markets, we don't trade economies, and they very much can move in opposite directions. Now, we look longer term, we do see that the stock market typically does trend with the economy, or you could say the economy trends with the stock market. But we found these two really good examples, and we wanted to share them with you this week. And it's looking at the declines in both the economy and the market back in 2000, and then we're going to look at 2007 and 2008. So this first example looks at 2000. We see in the blue line is the S&P 500. The kind of orange, yellowish line is a coincident indicators. What that means is these are a group of economic data that moves with the economy. Now, we only get GDP reports 4 times a year. Not very often. So we can look at other data that moves in coincidence, kind of in step with GDP type data to get a little bit more up-to-date look as whether the economy is growing or contracting. And what we can see here is you'll notice the blue line peaks well before we start seeing that coincident data, that economic data, start to roll over. The economy was still moving higher, was still increasing, still growing, still looking strong, while the stock market already had begun its decline in what we now, looking in the rearview mirror, can see was a multi-year downtrend, bear market. We can see the same thing happen back in 2007, where we can see the same type of chart as we'll put up on the screen now. As you can see, that blue line peaked well before we started to see economic data begin to roll over. And that's why it's not that we ignore economic data, we very much pay attention to it. It comes out in some form or fashion almost on a daily basis. But we want to make sure our reactions, the things that are driving our processes and our decisions, are focused more on the things that really have an impact. What's happening in the fixed income market, like Adam was just describing with the Fed and the change in short-term and long-term interest rates, and looking at the stock market and seeing, are we seeing health and seeing good trends there? And then we start to evaluate, is the economy starting to confirm that type of data as well? But we often will see the market will move ahead of the economy. And so that's why we really try to stay focused on looking at market related data and then start looking secondarily at economic data. All right, now we're going to shift that, and we're going to shift now right into some seasonality. So one of the things that we talked about back in the start of July with our weekly allocation meetings was July is actually one of the better months in the summer for the stock market. Stock market traditionally can be fairly volatile in the summer months. July has historically been one of the stronger periods, and we did see the market was up several percent in July. Now we start moving into August, and that's where things can get a little bit more bumpy. We can see on the bottom panel of this chart, it shows the average return for the S&P 500 since 1970 for each month. And if you'll notice, you can see there July is typically a pretty good month. Now we move to August. Historically, it's been about flat. A slight increase in September actually has averaged to be a decline in September. And so we need to recognize that when we start moving into the latter part of summer, that and into fall, which I hate to say, start to get colder again. But for the market, we do start seeing a little bit more volatility, a little bit of a decline. In the top panel of this chart, you can see kind of an average year for the stock market. Traditionally, very thankfully, it goes from the bottom left to the top right. And traditionally, we do have the market being an uptrend, but we can see in that middle portion, the part where we're at right now, we do see it start to kind of flatten off. We see a little bit of a dip there if you kind of squint towards the end of August, towards the end of September, where we can start seeing the market get a little bit more bumpy. So that's something we do want to recognize. The market's had a very strong start to the first half of this year. Maybe if it starts to digest some of those gains, but seasonally we do recognize this can be maybe a little bit of a rougher patch over the next 2 months. And traditionally we do see the market show a strong year-end rally, both on an annual basis, looking at pre-election years, different ways we can all chop up the data. Traditionally the market does kind of have that little bit of a bump in the road and then end on historically a positive note. We'll see if this year follows that path as well.
Very good. And thank you, Andrew. And thank you to all of you for giving us your time. As always, we give you a reminder to give us a call if we may be of service to you, or if we just haven't seen you for a while, 800-928-4001, or scan the QR code. We do. Thank you very much. And either way, we hope you have a great weekend.